Loud. Okay, I think it's recording. So let me share my screen. Okay. Okay, now it's, I think SPX has reached some resistance around 29.80, 85. I had to do quite a few adjustments today. Yeah. Where's my, okay. These are my positions. So my position, I closed September. I was getting a little bit tired of it. I see the RTT has been struggling, but mine are just closed for a fantastic, I think $50. I just wanted to get rid of it. October is doing fine. November is okay, I think. My November is, yeah, it's okay. And I've got so little upside risk. I mean, yeah. So at least I can concentrate on this little trading group and my program. Yeah. Anyway, so I'm going to show you some examples a little bit later. But let's start, and I suppose people will watch the recording. Right. Okay. So today, I know I'm scaring off a few people, but we're going to go a little bit more into the SKEW. I wanted to talk only 30 minutes and discuss, but it seems like most discussions are actually occurring offline. That's fine. That's fine. I mean, I'm still pretty much adamant that rule-based trading doesn't work anymore. Because we always have different volatility environments, and I'm going to show now that we are also in a kind of odd environment. We are teasing with all-time highs, and volatility, even though it's gone down, it's actually not that low compared to 2017, for example. So it seems that market dynamics keep on changing. That's actually the rationale behind this trading discussion, is actually to try and understand what's going on and make better decisions.
Yeah,
so,
a completely different environment. 2017, the market basically just went up quietly, as opposed to this year where we've seen a lot of volatility.
Yeah, if you remember, Boxing Day, it was actually a low, and then it went relentlessly up to break new highs in the first quarter. And so it's I don't know. I mean, again, I could be wrong, and I don't have a holy grail type of solution, but I just want people to have a little bit more material to think about it. So last week we talked about SKEW, and to actually define it very concisely, it's just different volatilities for different strikes. And we spent some time on the vertical SKEW. A lot of people are actually a little bit wary of horizontal spreads. So I would say the vertical SKEW across one single option chain is the most common scenario. So I'm going to recap also to get people up to speed with what the SKEW is about. So this is a typical put SKEW here, and it's plotted at a given DTE or expiry date or time to expiration and a given volatility environment. And the major forces at play to actually make this thing change are the ATM volatility. As a matter of fact, the underlying only knows the ATM, and then through modeling and arbitrage or no arbitrage opportunities, it then spills over to the rest of the chain. But what's happening is essentially right here at the money. And of course, whatever I'm going to say, or I said last week or last time, and is that this is of course very much model dependent and asset class dependent. I can't help assuming that most people like me are trading index options, and I am more now specialized on SPX, although I trade the baby rhino on the Russell because it's just more convenient. But it's important to understand that if, and this is not a trading course, it's just a trading group. But I can't just make it general. And the SKEW is actually very different according to the instrument you're trading. So this is by default an index option type of SKEW. And also the other assumption that is, of course, quite related to my trading style, this is more for ATM traders or near ATM traders. We are all, at least most of us, we are net sellers. We want to sell volatility. We want to capture premium over time. But there are, I mean, of course, the options world is so versatile. There are so many ways to, even in that segment, it's still very much, there are lots of different traders. So I just want to make it clear that my thinking and this discussion is, of course, influenced by my trading style near ATM. And I'm saying that for people who trade more STT, far OTM, far dated options, it will be a different picture. So this is more a 2 to 3 month horizon, RTT, Rhinos, maybe the X4 for people who follow John Locke. So this is more, everything I'm going to say is, of course, related to my trading style. And I understand your comments last time that you don't really know how to translate that into your own trading, and I understand that because it's actually modeling, an expression of modeling, and I've tried to actually make a breakdown or a concise summary of what the SKEW does to your trading, but at the end of the day, it was my own trading. So, and that could be part of the discussion, is how the SKEW could affect your own trading style. That would be the interest of a more active discussion. Excuse me. Every time I talk too much, I end up coughing. So just to keep things simple, let's assume a 40 DTE SKEW. The volatility is average to low. I'm not referring to 2017 in particular, but when volatility is low, ATM vol tends to be pushed down, and of course this kind of strikes would not apply. I mean, 2017 we were somewhat lower, but the ATM volatility is down, and we see the SKEW or the gradient of the SKEW or the shape of the SKEW. Basically, the OTM volatility goes up, and I'm talking on average about 40 DT. I'm going to show on because actually I trade on Interactive Brokers, but IB has got some nice charting. Unfortunately, not accessible through the API, but we're going to see according to the time to expiry how the vol SKEW changes, evolves. What we see in lower IV is that the inflection here of the vol SKEW appears a lot later in low IV. This is typical of a vol crush or a volatility going down strongly, and it actually prevents the smile from appearing. So this is already a low environment, and we assume the volatility going even lower. So in that case, the vol SKEW will be straighter and steeper. So that's something that, in a way, is easier to handle because there's some noise. Andrew, can you hear me?
Yeah, I can hear you. There's something else.
Okay, I can't actually see who's there, but it seems to be coming from there. Anyway.
Seems Ron's mic is still on.
Right. So in a normal environment.
I think you have to mute Ron.
Okay, but how do I do that? Participants.
Add it.
Okay, sorry if I mute someone, but let's see whether it makes things better. So when volatility goes up, of course, the first thing that happens is it actually occurs ATM, at the money. I mean, when volatility has an effect, it's of course on the underlying. And the effect on the option chain is kind of, it's almost like a ripple effect. It spreads across the option chain, but everything happens at the money because it's all dependent on what's happening on the underlying instrument itself. And what we see when the market, again, more or less at, I would say, midlife in the life of the trade, we see the ATM volatility going up, and the OTM, here I'm talking about the put, but if we talk about indices, I could actually go back to the put call parity and what's happening on the call side. Again, I am also kind of, in my own way of thinking, index trading more puts than calls. I don't mind going, out of the box and discussing things that I don't trade, but just for simplicity, I'm going to follow my own line of thought and my own type of trading. So the OTM OTM volatility will tend to flatten and go down, and you start seeing that smirk. So the ITM volatility starts showing. And if volatility is average to low, it's going to take longer for a smirk or smile to emerge. And if volatility is higher and we are into the market going down and volatility going up, the smirk will be more visible. The ATM vol will go up. The OTM volatility will straighten up, and overall the gradient or slope will go down. So that's something that we can take into account in your own trading. The good thing is that when volatility is average, or more or less what volatility is right now, is that if you have a straight volatility line and not a more complex polynomial or something more exponential, or depends on how you want to model volatility. But the thing is that if volatility is higher and you trade longer DTE, longer dated options, your OTM volatility will be straighter. And if you have to, for example, do reverse Harveys or rollbacks or anything along that volatility line, is going to be easier because you don't have, that's actually the perfect case where you don't really have to worry about the vol skew. Because if volatility is normal to high and you are far OTM, it's going to be straight. You don't have to worry about whether your rollback, for example, assuming a rollback, is done in good conditions or not, because overall the pricing will be consistent across the chain from OTM to far OTM. And even though I believe the RTT doesn't really deserve its name anymore, it's actually a more complex trading style. Overall, I would say that from a volatility perspective, a bearish position trade on a long-dated strategy should be easier to handle. And that I could come back to what I said in the first session about being, I wouldn't call it academic or intellectual, and trying to understand and dissect everything versus intuition and experience, but I can understand why someone as experienced as Dan came up with an RTT, and even though he has never really formalized how it made sense to be on a straight OTM volatility line, I think overall that's what he wanted to do. He wanted a simple trade on a flat enough volatility line that by being starting the trade probably 80 or more days to expiration, and also placing the trade a little bit more bearish than typical broken wing butterfly strategies. So again, that's where you can try and analyze, or you can use your intuition and experience, but both way of thinking must actually converge, so to say. So let's go back to this. So on a higher volatility environment, now I'm placing this example 20 DT. So coming back to what I said about an RTT, it should be closed by 20 DT. I don't understand actually why trades that are started very early would need to be kept so long. I would understand that if you are consistent with your trading style, and again, trading along a flat vol curve, you want to be out of it before the inflection or convexity starts showing, and the smirk or smile starts maybe bothering your trading. So, but if volatility goes up, you will have this volatility going down. I'm not going to, again, this is not a training course, and it is not an analysis of a trading strategy as such. So I'm just giving some cues, but you can then see for your own trading how if you have, for example, an STT or an RTT, how the change in the gradient slope or inflection of the vol curve influences your pricing, because maybe your PCA side, because of course if you trade a broken butterfly or STT condor, unbalanced condors, you make money on the PCA side. PDS is a cost, so you want to see how it affects the premium which you want to have released. That's also something I will gradually get into, is actually looking at every part of the trade and see, because a lot of people just follow rules, and also they don't really look at where they make money, where they lose money. So slowly but surely we'll get into that. On the long weekend, I took a snapshot of volatility for the September expiry. And here you can see that end of July, 56 DT, we had a very flat. So again, that confirms what I said. If you start very early and you don't want to get too close to expiration, whatever you have to do will be simple, because you will deal with a vol skew or a vol line, I would say, that is pretty much straight. Over time, the trough, the bottom of the vol skew, will slowly come closer to ATM. So because a lot of people don't really trade, and again, this is more an ITM vol skew. And I will show some on IB, the current vol skew, but we will see the effect, for example, of the bid-ask spread. It's actually not a good place to be. You don't really want to trade ITM puts the same way that you don't really want to be too far OTM because of spreads. And I understand that the market makers are trying just to make sure the pricing is consistent, and modeling cannot allow arbitrage opportunities, but we will see that spread can make the pricing quite difficult to come with an accurate type of value. And then when I prepared this presentation, I thought, okay, let's try and come up with a table where we would see different stages of a trade, takeoff, when you start usually, and that's where actually the RTT name came about. I mean, takeoff, the trade is just, you could leave it on for a while, nothing to worry about. But then I realized that, again, if it's an RTT or an STT or a Rhino or another trade, it's going to be different. Overall, when it takes off, it's actually better to be in a higher volatile environment, of course, because your T+0 will be fairly stable, quite resilient. You don't have any smirk or smile, so your vol skew is actually pretty straight. So this could be pretty much constant across a lot of strategies. But when I try to fill in the little boxes here, I realize that no, it's actually complicated. Something that is probably common to many strategies and weaknesses of many broken wing strategies is that when you are in a low environment in a descent phase after 30 DTE or even closer to expiration, if volatility is low and getting lower, you will have trouble with the vol ATM being crushed. It will delay the smirk. The skew will become very steep, and your T+0 will be fragile. And coming back to what I said in an earlier session, would be a good time to look at VOMA and maybe the sensitivity to Vega in general. And another thing, this late in the trade, is that market makers and institutional traders start rolling over. I mean, everybody thinks the rollover starts about a week to expiration, but not all expirations are the same. Quarterly expirations are more palatable. So if you are now into November, for example, I would expect that the rollover to December, which is a more widely traded expiry, the rollover will start earlier, and you may have then lower liquidity on your November trade. Same with October. September was a more actively traded expiration. So all those things come into account. That's why when we backtest, for those of us who do backtest, sometimes we don't take into account all those details. But I think, again, this is just an invitation to think that sometimes not only the dynamics, the volatility, the environment can change, but not every month is the same. I've spent a lot of time talking about the vertical skew, and I want to be pretty short on the horizontal skew. So the horizontal skew is calculated using ATM implied volatility across a variety of expiries. I would suggest that it's to actually analyze or study the expiries that can have an effect on your trading strategy. And I would also recommend that you don't spend too much time closer to expiration. That's where the modeling can be complicated. You have liquidity issues. Actually, let's just have a look at, I've just put in my demo account. Let's have a look at, this is September. This is September, the market is going up, and this is the bid-ask. And it's actually not far, this is 29.55. So this shows that the bid-ask is starting to spread wider, and it's actually not too far from the money. The issue or problem of ATM bid-ask spreads is, I would say, more normal, and let's say I show October instead of September.
Once you get into the far out of the monies, the minimum tick size starts influencing the volatility and distorting
Very
it.
good point. Yeah, very good point. It is true. Because you get a theoretical price, and the market makers will not budge a finger. So you have a kind of a no man's land in between, because the market makers are not going to give you a cent if the theoretical pricing gives you something that is not, if it's halfway through between the 5 cents tick size, I mean, you will have trouble getting a fill unless you start giving in or be patient. But yeah, that's actually a very important point. Not only there's a liquidity issue, but because of prices themselves, yeah, you will have trouble getting a fill. Yeah, it's actually a very good point. Yeah. But this is actually unusual. I would not have expected for October. October is still about 40 DTE. I would have expected the bid-ask spread on October to be okay, maybe all the way down to 28, 2050. So this may also show that some people, I mean, the market makers are a little bit shy on pricing OTM volatility right now. So this is actually a good indication. Let's have a look at December. December should be simpler. What's actually surprising me is that if I plot October, November, the volatility, yeah, I actually noticed that, but it's actually a separate issue, is that I noticed that the December volatility is actually quite low. And I put on some kind of a campaign calendar. If we have a look at maybe the December volatility on VIX Central. Now, of course, we're back into contango. But earlier on, we had a little bit of a trough here, and short-term volatility was higher. So that it was actually a good way to make easy money on a calendar, September, December calendar. And if we have time, I'm going to show that in option view, and I also put it on Excel. But if I go back to so as you can see, the December is actually steeper. We would think that December being over 100 DTE, we would have a much flatter vol skew overall. So as usual, the bid-ask spread for ITM options is large, but it's actually, so again, this is for me an indication that a lot of people are probably on even market makers are, of course, they have a duty to deliver liquidity, but you can see the appetite to be in the market or not by the bid-ask spread. And the actively traded range is actually pretty much narrow, in my view. But anyway, so so the short-term volatility is itself, maybe I could go back to this. Oh, sorry, it doesn't go back to the last. Yeah. Short-term volatility and ATM volatility, because that's where things happen, is more volatile. So, and the volatility then, again, for various reasons, will then, it's kind of a contagion effect of the longer-term volatility. When the market is, I would say, behaving normally, in maybe wavy ups and downs, but on a longer-term bullish trend. So the structure will be in contango, and the longer-term risk by holding, just simply holding a longer-dated position, will of course show in the underlying volatility extracted from the prices. But let's say the whole thing will appear normal. But when you have, and if we go back to this environment now, where volatility has been, where's that? Can I? Looks like I'm losing. Okay. Sorry. How do I get rid of? I can't get rid of the. Oh, there it is. Okay. Okay. This is the ID, and this is the volatility today, dropping as the market broke the trading range that it was in for some time. But this is volatility, I think, 2 weeks, and so that's a month ago. So when you have this kind of volatility swing, this is a month ago, to now, the short-term volatility has dropped enormously. This is not exactly normal. So usually, when you are in contango like now, I would say it is normal that you have more risk keeping on a position for a longer period. So this is actually a simpler environment to study. This change from backwardation to backwardation to contango, of course, has a lot of influence and impact on your trading. This is actually something, because we're talking now about horizontal skew, this is something that is very beneficial to calendar trading, because you have a short-dated short leg, and volatility drops on your short leg, and volatility then starts spreading over longer-dated options, the long leg of your calendar. So this is really typical of a horizontal spread. Your calendars will do very well, and we'll get back to that in the example I want to show. But I think I'm talking too much, because I wanted to have a 30-minute discussion, and we're already halfway through. But I hope I'm making myself clear, and also we can get back to this anytime. I wanted to show some examples. Okay. Volatility surface, which will be a future topic anyway. Yeah, I wanted to talk about weighted Vega. Because horizontal spread and the behavior of calendars, when I prepared this presentation, I thought, well, okay, that's maybe a good time to have a short presentation about weighted Vega, something that became very popular 2 or 3 years ago. Ron Bertino came with a formula that he actually used a reference from Nassim Taleb in one of his books. Very, very smart guy, that Taleb. And the formula he came up with, which is raw Vega, or the Black-Scholes Vega, should be somehow compensated with a factor, which is basically the square root of the time to expiration divided by some base DTE, and the number that was proposed was 30 DTE, or a month. So, of course, being on the academic side of things, I thought, well, okay, I love formulas, but I need to see some rationale. I need to see what motivates having another type of Vega. And you will notice I call it a time-weighted Vega. I wouldn't be as enthusiastic about it and call it a true Vega, but some people call it a true Vega. And so I was a bit puzzled, or that there's absolutely no academic reference about that so-called true Vega. I looked on a few quant forums, and I found some interesting questioning, some interesting studies about it. And of course, weighted Vega will be less of an issue, problem, or a compensation if you trade everything on the same option chain. But if you have a horizontal spread, and so you start betting and hopefully banking on volatility differential, it's important to see whether your long-dated Vega is accurate and your short-dated Vega is also accurate, so that you can figure out whether the profit potential is what it what it tends to be. So let me. So looking at those forums, I saw that it could make sense to have a Vega sensitivity proportional to that ratio, 1/square root of time. That's actually the basis of that time-weighted Vega, and of course it could be looked at a term structure of IV, and for people who, like me, look at VIX central every day, contango, backwardation, VIX behavior, it could have some sense. But then, and I'm not saying that Black-Scholes is 100% true. There are some weaknesses, and we talked about them in an earlier session, and we'll go back to that. But the very basis of Black-Scholes is that the variance is itself a sigma squared times a time to expiry. And if you add another square root of time to it, it would mean that Vega is itself dependent on the variance of, so the volatility of volatility, so to say. So, and it doesn't pan out. It doesn't make any sense. Vega is an estimation of price change according to a change in IV, not in a change in variance of IV. So it doesn't make any sense. And if we look at the Vega formula itself in Black-Scholes, the square root of time is already in there. So why would you add another square root of time? So by spending some time understanding the rationale behind the time-weighted Vega, I can only see that, and I could generalize about trading strategies that kind of fit a typical or a certain market, and mentors and experts and people who sell their knowledge and expertise, they will go hard on selling, this is the right thing, this is perfect. But at the same time, that overfitting makes it not so reliable over the long run. And I start to think, well, that kind of fix or compensation, I can't deny that. I watched the Ron Bertino's video. He's a very bright, smart guy, and it made a lot of sense at the time. But really, does it really work? So I'm going to I'll put on some examples of horizontal skews. So let's go to August the 2nd, and of course these are ideal trades. But Ron in its presentation also used kind of ideal trades. So let's go to August the 2nd. So in a way, this is the same as with me. I mean, but at the same time, I'm not trying to prove anything. I am more looking at disproving something. So let's go to August the 2nd. And let's have a look at example. Oh no, don't tell me. Oh, maybe it was. Oh, no. That was 3:25 p.m. Yeah, so it was the end of the day. That explains why this example is not shown yet. Right. Example 1. Yeah. So here I am showing a typical put calendar. We can assume that the market was going down, and we would want to have a hedge positioned 28.25. So 28.25 was around here, or could, anyway, for whatever reason, but we can assume that that trade would make sense. So I enter that trade on the 2nd of August, and I'm going straight to the exit on the 5th. Yeah. So let's go to the 5th. So just one weekend, a few days. Okay, the market dropped. So the market dropped. What is my, okay, and I made $73. What did I say here? Exit, example one, oh, $83 by 240. So let's put 240. Was actually an hour earlier, but anyway, 83, 73, that's all the same. So if I then go back to, so it was a, let's look at the environment. Entry was in a flattish contango. This is the vol, horizontal vol skew. This is maybe not important to look at a 2-year projection, but it's more the short term. Let's say we were in a contango for up to 60 days, and the markets after that fall went into backwardation. So the skew, let's go back to the entry. A bit slow. IV for the short leg was 1892, correct, and the long leg was 1833. So a positive vol skew. Generally, it's pretty good. And if what was the expected P&L? 163. So if I go back there, and I want just to save on time because we are already 3/4 of an hour. But if I was to project T+3, T+4 at 28.25, the expected P&L was 163 on the same day and 218 at T+3. If I use Vega, I have a $114 of Vega. And if I assume, this is September, October, so I calculated the time weighted Vega using that same formula, there should be no Vega at all. So the Vega would have been $14. Theta is not that much. There's $38 of Theta. And I chose this trade to be flat. Delta was -3. It would actually flatten to 0 around 28.30, and it was actually 28.30 on that Monday 5th. So if I calculate what would be the expected P&L, so the actual P&L was 83, 85 without trading costs. But the time weighted Vega would have given me only 14. The normal Vega gave me 114. So I would say the regular Vega gave me expected, the profit. The expected P&L was 218. The actual was 83. I was actually 72% from the anticipated Vega-related profit. But it was actually a lot more than what a time-weighted Vega value would give me. So what is closest? I would say the regular Vega is actually a lot closer to what happened. Let's just look at it as one example.
Looking at the volatilities on entry and exit, I'm surprised the trade was profitable at all.
Well, the market dropped. It's supposed to be a Vega positive. So, and I chose an entry at 29.30. Over the weekend, the market dropped 100 points. All I'm saying is that the profit, the market was actually profitable because you already had some positive skew. So that's also something that people don't really understand, because if you are in a contango, and I haven't spent time revisiting the examples that Ron used 2-3 years ago, but that was very much a contango environment where your skew, your original skew was probably negative. So if your original skew is already negative, so the reason why it didn't produce is that when it's time to close the trade, your skew actually deepened. I mean, you had actually a more vol difference to buy back, so to say. But if you start with a negative skew, which is quite understandable in a contango environment, and even more if you were doing a campaign, so your short leg being short dated and your long leg being far dated. So the horizontal vol skew would be largely negative. Then you would be hit badly. And if you hit badly, your horizontal skew will hit you and you will make a lot less money. So you were surprised that this calendar made money, but we are in an environment where, let's look at the horizontal skew, volatility was already high. So the effect of a 100-point drop over that weekend was relatively contained. So what I'm saying is that when you look at weighted Vega or normal Vega, and when you do your back test, you have to look a little bit deeper, closer. What is the vol environment? I've placed myself in an environment where, of course, volatility could have been more contained. We could have just had maybe volatility going up a bit and keeping a contango style. And then I would assume that this differential would not have been multiplied by 2.5. And as a matter of fact, if you look 2.5, that's more or less what we lost from expected profit to an actual profit. So
that calendar Vega number that you have,
yeah,
that's actually for the trade a negative number, isn't it?
Yes. Let me see. B15 minus. Okay. This is the time compensation. Vega P&L B15 minus B6. B15. So this is the Vega differential between entry to exit. Yeah.
Yeah, I mean that 0.59%. You're actually short that in the trade.
Before I am sell. Yes, that's right. Yeah.
So you went from negative 0.59 to negative 1.23.
Yeah. Yeah, I put in the figures in the wrong way around, but
that part of the trade went against you.
Yeah, exactly, by a factor of 2.5, yeah. Which in pricing, because volatility. If you look at a trading example where theta is not really important and delta is not really important, I want to place myself in an example where we really look at the horizontal skew effect on a very short trade. And so that 2.5 ratio or factor is exactly why I lose the expected profit was actually divided by 2.5. So exactly that. But what I'm saying is that if you already have in a flattish contango or flattish term structure, you have some, okay, you couldn't say it's negative, but I mean, it doesn't really matter. You already have a call, I mean, a horizontal skew in your favor, and it goes slightly against you, but you don't go from a short volatility being very low and the long volatility being much higher because it's far dated. So in this instance, it actually didn't go too badly against you. So now let's look at example 2. I think example 2, I didn't go too far. I think I entered at example 2 right after. What example 2? Example 2 was 240 on the 5th. So it should be, why is, oh, sorry, I'm on the 2nd. Oh, silly me. Okay, this is the 5th. So basically, I assume that I closed that trade and I entered another one. So I entered that other one on 240, so an hour earlier. Oh, no. This is, sorry. I let's switch to example 2. Yeah. And now I go to, okay, so example 2, I enter this trade. Let's say I closed my first one and I enter the same one. I mean, it's just for the sake of looking at 2 trades instead of 1. So I enter the trade at, this is French time, 2:40 Eastern, and this is what it looks like. So I entered 2:40, short IV was 2072. I don't think I got it wrong, 2072 here. The long leg was 1949, so even if I maybe put it the wrong way around, the differential was 1.3. And we start with a backwardation, strong backwardation. So in other words, we sold that short-term volatility quite well, and we bought a cheaper, longer dated volatility. And I'm not looking at far away. I mean, this is 0, this is 30 days. And again, I'm going to just going to stay for a few days. So we go to the 9th. Oh, no, yeah. I didn't actually close that trade. So let's go to the 9th manually. Right. And in my example, the 9th, 310. So more or less this time, 320. Okay. So what I was supposed to do, I was supposed on this calendar, T+0, I was supposed to lose 131. So by adding a little bit of theta effect, I was supposed to lose $54. Okay, I could go back to time of entry, do the projection, etc. So let's go quicker. So I was supposed to lose money. I was supposed to lose $54. The Vega value of this trade was 106. And if I look at the time-weighted Vega, no Vega at all. So at least from the money I was supposed to make, I made $33. So I made almost like $100 more than expected. And of course, and a lot more than if I was expecting no Vega effect, because if I use the weighted Vega, there's basically no Vega at all. So my point is that the horizontal spread in terms of Vega, or sorry, IV differential went from 123 to 64. So and it actually compensated a lot for the anticipated loss. So I was supposed to lose a lot of money, and in the end, in the market going up, I ended up making a bit of money. I mean, of course, it's not great. But what it shows is that you have to look at the volatile environment when you enter the whatever horizontal spread and when you exit that same horizontal spread. If the volatile environment has changed enormously, it will have a huge impact. And this is actually a lot more significant than whatever time-weighted Vega. The time-weighted Vega does not project pricing any accurately at all. So this is actually my point in these two examples. But I see that I'm actually getting close to an hour, so I'm going to stop talking and I will carry on this topic next time. But at least if I planted some seed that you need to study when you calculate, and you, of course, again, I go back to that sense of complacency. We just want to implement and apply rule, and this time compensation looked pretty good, but looking at the theory of it doesn't tally, doesn't make sense. And when you look at examples, and again, I'm not denying that Ron's examples 2-3 years ago were correct. Of course, I'm sure they were. But what I'm saying is that you have to look at the vol environment and the vol changing environment. So you have a contango, flattish, backwardation, and if you happen to have an environment that goes from backwardation to contango, you can have a market going up, because I chose from August 5th to August 9th, the market shooting back that same 100 points. So yes, on the way down, we didn't make as much, but Vega gave a pretty good picture. And on the way up, where we would be anticipating the calendar to lose a lot, it didn't do too badly. So both ways, you know, we made less when we were expecting to make money, but we made a lot more than we were expecting to lose. And I would say that normally it's actually a good idea if you think the market is going to bottom out to actually enter a calendar. Okay, you will not do great if the market bounces off very strongly. I mean, I'm not saying that this was a great trade, but if the market had actually been, because this is a very strong recovery, but if the market, and I could actually look at, let's maybe just, I didn't actually try that, but let's go a day earlier. Market, when was that? No, maybe 2 days earlier, let's say. Yeah, so the market was, okay, there are only 2 days of theta, and it's a bit slow. Okay, let's have a look at the trade after only 2 days. You see, I entered right here. 2 days later, the market has recovered 50 points, 50, 60 points. If I go to the entry and I project 2 days, the market going up 50, 60 points. Okay, there's maybe a little bit of theta, but I was supposed to, let's say, flat. And if I go, and now I go down 2 days, $100. I was supposed just to keep more or less at break even, $100 on the market going up and the volatility going down. So just again, I'm making, and actually at that time the backwardation had not actually abated that much, but it did on a very short-term volatility. This is a 30-day volatility. So I actually invite anyone who wants to analyze time-weighted Vega, horizontal spreads in general, more in the light of the general volatility environment on your short leg and your long leg, and how it actually affects your trade a lot more than you would anticipate. So I can relate to people who just want to stay away from horizontal spreads because it looks too complicated. But if for any reason you want, or you think it would be a good thing maybe to, as a Vega hedge or something, well, if it's a Vega hedge, you know that if the market doesn't go in your direction, you may not lose. You may actually make some money. And if the market falls, you probably won't make as much as you expect, but it won't be bad either. So yes, it's actually living with uncertainty. But if you know what you're doing, if you can scratch a little bit under the surface, you will see that there is some merit in using those instruments, knowing their strengths and weaknesses. Anyway, I'm talking too much, but maybe Andrew, if you have any questions before we close.
I think that trying to analyze or predict horizontal skew suffers from the same problem that trying to predict vertical skew suffers from, and that's ultimately it's determined by human emotion.
Yeah. Of course, the psychology is quite important. I see a question from Gary. Increasing volatility OTM does not really go down there. Although I think it was relating to vertical skew earlier. Yes, you're right, Gary. Okay, my earlier slide didn't go into as much detail as I've gone into now with Weighted Vega. But it is true that if we go back to the presentation here, where was that? It is true that the effect, the ATM effect, is a lot more significant and visible than the effect on the gradient. Yeah, it is very true. Yeah, but and there again, I took it's just an example at 40 DTE. It will be different on 20 TDE, and it will be different also on longer dated. If it's let's say you start a trade, you are 60, 70 or more DTE away, and the volatility will just shoots up, it will have more effect on OTM. Let's say that when you are 40 or closer to expiration, the two forces will go once against each other, and so you will have the pushing down of OTM volatility, but as much as time value is being released, it will compensate to some extent. So that's why when there's a volatility surge ATM, depending on the time to expiration, you will have more or less effect. But I agree, these two arrows should not be of same size. I mean, generally, this has more effect ATM than it has. It's more like a ripple or a spreading or contagion effect across the option chain. And I could go further, but now we are really over now, because there's also the interesting concavity here that we could analyze. And this is typical of this weird environment. There's additional hedging here further away, OTM, that actually pushes this concavity. I mean, the vol skew should remain convex. So there is something happening here. Anyway, but we'll discuss that some other time. Anyway, I hope you enjoyed this topic. We'll get back into that. Yeah. Again, it's just if you ask yourself questions after this, to me that's a bonus. That's positive. Okay, so I'll see you in 2 weeks. Thanks for listening to my rambling. Okay, have a good end of the day, and we'll talk soon. Bye for now.
Thank you, Bruno. Bye.
Thanks, Gary. Bye-bye.